Uh, Good afternoon, everyone. I think after a good and heavy lunch, I hope this session will make it interesting for everyone to keep awake. So it's a challenge for all of us. Indeed, first of all, let me thank the organizers for inviting me to this session to chair the session. It's an honor and privilege to chair a session with two important and great personalities to govern us. One from the region, other one is from obviously from the advanced economies. So first of all, I'm not going to repeat what was discussed in the morning, especially on the topic that we seen today. Obviously, main theme on the turbulent times. But today this session we are going to focusing on specifically on the central banking in turbulent times. For that, we have two eminent speakers, Jean-Claude Malhotra from Central Bank of India and Governor Trichet from former ECB and from the France governors. It's indeed a pleasure to have them here. Just to set the stage at the beginning for about a couple of minutes, before I invite two eminent speakers to talk about the topic. First of all, I think when it comes to turbulence times in terms of geopolitical fragmentation, trade barriers, so all these things that we discussed in the morning, this is all about central banking. As you all know, central banking is more about the domestic policy orientation. This monetary policy is mainly to stabilize, targeting the price stability in a lot of all the central banks. That's why we are talking more focus on the central banking is to obviously looking at more domestic side of the economy, but obviously this has our mandate, central bank mandate has influence on all the other global turbulence, geopolitical tensions and trade tensions. Obviously, we have to be mindful and its impact and influence on the domestic economy. That's where the central banking is all about, and how we can basically measure the risk and how we anchor inflation expectations, how we can deliver our mandate of domestic price stability. That's where basically we can have more focused discussion, especially on the stability and especially in terms of domestic price stability. So when we look at the challenges that we are facing by the all global events, for example, all this pandemic. So, for example, now we have seen in the past, for example, in the global financial crisis earlier, then obviously central bank had to play a very critical role. And they also talk about the monetary policy is the only game in the town. So because the central bank has been playing a key role when there's those kind of event, central bank will have to respond quickly, and our ability to respond is quite important to stabilize economies. That's why even in the pandemic, we are seeing the central bank's role in stabilizing the economy during this kind of external shocks, although we are focusing on domestic price stability. That is very important for us to understand this role of the monetary policy, and the role of the monetary policy is to, stabilizing the domestic economic price stability in the context of global economic challenges. So going forward, what we are talking about turbulent times in terms of other emerging uncertainties here. Obviously, there will be challenges for the central bankers. There will be challenges on price stability. And then question is that how we can meet those challenges. And obviously, other part is that with these challenges in these uncertainties, growth is going to be affected. That we are seeing the slowing growth in globally as well as regionally since the pandemic and also since the global financial crisis compared to the earlier periods. That's where the role of the central banks is also being questioned, and also expectations of what central bank can do in terms of stability as well as supporting or achieving high growth for the people, especially this part of the world, relatively low-income countries or relatively low-income countries compared to the advanced countries. So in this context, Now, there are a lot of other challenges in terms of central banks now, but we see emerging technologies, the digital currencies, the digitalization, and also the financial spillovers, and the impact of these other impacts on the domestic price stability. All these things are very important. So for that, I think we have 2 minute speakers. So hope that in the session, especially Reserve Bank of India, the governor, obviously we know India has now very well established inflation targeting framework that has been there for some time, and credibility has been now strengthened and has been successful in meeting inflation targeting. And also the questions, I think, whether this inflation targeting regime, more flexible inflation targeting, whether it is relevant today, whether there are being debates going on, what are changes that we need to move forward as central bank is. And also there are new challenges, like for example, Indian Reserve Bank and Indian government is internationalization of INR is one of the new initiatives that we have seen. India is taking the lead. That is also to address some of the challenges that are emerging because of all these other uncertainties. And also new technologies like central bank digital currencies. That's also new technology coming up. And also other part, the new one is the role of digital financial services, especially this part of the world. Is very important that Central Bank of Central Reserve Bank of India is taking the lead. These are the areas we hope that Governor Malhotra can touch on, and also anything else, especially on the monetary policy, price stability, and the role of central banks in these uncertain times and turbulence times. And on the other hand, we have the Governor Trichet. This is a very well experienced governor, being the Governor of Bank de France and also the ECB for a long period. During his period, he has had enough exposure, especially to banking issues in the Europe, and also economic crisis in the Greece, and also his role during that period is quite important, and also his kind of thinking about the current new challenges in the global economy. I think I hope that he can contribute in this area. With that, let me first invite Governor Malhotra to share his thoughts, and then followed by Governor Trichet, and then we will have a few question answers, and also if time permits, we'll open up for a few questions as well. Thank you.
Governor Weerasinghe, dear Jean-Claude, all participants, distinguished audience, a very good afternoon to all of you. It's indeed a pleasure for me to be here amidst all of you. The theme of the session could not have been more apt. This is a topic which is at the forefront of all central bankers navigating the complexities of our current global landscape. The last 2 decades have been, to put it mildly, a lesson in humility for the central bankers. They have traversed through a past period of deceptive calm to one of perpetual crisis management, one after the other, in the last 2 decades or so. The standard models that the central bankers have relied on, which assume a certain level of stability, predictable relationships, they are creaking under the strain of these new realities. Their explanatory and predictive power is being questioned. This brings us to the crucial point, which is the role of the central banks. The very nature of their roles has evolved in many economies, from fine-tuning stable economies to act now as first line of defense against a series of unprecedented and sometimes overlapping global shocks. This reminds me of an old mariner's wisdom. You cannot control the storm, but you can certainly steer the ship. That's what the central bankers are meant for. This is the essence of modern central banking, navigating through turbulent waters with a steady hand, guided by the stars of stability, price stability, and financial stability. As some of you may recall, from the mid-1980s until 2007, it seemed that the central banks had virtually tamed the business cycles. Advanced economies enjoyed a long spell of low inflation and stable growth. The intellectual consensus that converged around frameworks like flexible inflation targeting. But the global financial crisis of 2008 and 9 was a rude awakening, giving way to a period characterized by unprecedented global shocks and heightened uncertainty. It was a classic Minsky moment, a sudden, brutal collapse of asset prices after a very long period of prosperity, but hidden debt accumulation. That crisis opened the door to an era defined by relentless series of shocks of diverse origins, from the financial sector crisis in the US, which exposed deep-seated fragilities in the global banking system, to the sovereign debt crisis in Europe, which threatened the very fabric of the monetary union, the taper tantrum episode of 2013, which sent shockwaves through emerging market economies like ours, and more recently, a drastic U-turn in the global trade policy environment, reversing decades of integration. The last 5 years in particular have been defined by overlapping supply-side shocks that have left significant scars on growth. From the COVID-19 pandemic and its after effects, the Russia-Ukraine war and its spillovers, and to the very frequent adverse weather events. These are not traditional demand-driven cyclical fluctuations that monetary policy was well equipped to handle. These were different, these were unprecedented, these were not something which one anticipated. These are complex, exogenous events that simultaneously dampened economic activity and fueled at the same time multi-decadal high inflation in many economies, presenting policymakers with a devil's choice. India too was not spared from their after effects. COVID pandemic resulted in India's real GDP contracting by about 5.8% in 2021. Subsequently, adverse weather effects and spillovers from the Russia-Ukraine war pushed headline inflation above the upper tolerance band of 6% in 4 quarters in 2022, all 4 quarters of 2022, first quarter of 23, driven by the sharp increases in the international commodity prices as well as the domestic food prices, which was accompanied with spillovers from food to core inflation. How did India deal with it? In situations where an adverse tail event materializes, the swiftness and the proactiveness of policy measures shape its efficacy and influences how fast an economy recovers. The flexibility embedded in India's, as we call it, the flexible inflation targeting, enabled it to focus on the growth recovery during the pandemic, even though inflation was rising, and then quickly shift gears to maintain price stability in the face of heightened price shocks that followed. Our mandate allowed us to look through some of the initial impact of the supply shocks while remaining vigilant against the anchoring of inflation expectations. A monetary policy response by the Reserve Bank to counter the devastating impact of COVID-19 pandemic was multifold, preemptive, and decisive. First, it preemptively reduced its key policy repo rate to its lowest level ever in the 10-year history now of inflation targeting. Accompanying it was a slew of liquidity augmenting measures, again unprecedented, very timely, aimed at ensuring ample liquidity in the financial markets for all sectors and thereby prevent seizures and credit freezes that were occurring in the financial markets in many of the other economies due to the liquidity stress. Amidst the uncertainty, communication, the other pillar of monetary policy, and forward guidance became key elements to the Reserve Bank's monetary policy toolkit. The Reserve Bank's forward guidance was usually state contingent, looking to and linked to the evolving macroeconomic outlook, but the Reserve Bank blended it as needed with time contingent guidance to reinforce the MPC's commitment to an accommodative stance. For example, the uses of phrases like as long as necessary to revive growth and mitigate the impact of COVID-19. On the whole, the Reserve Bank approach was balanced and prudent. The liquidity injection was targeted with preset end dates, allowing for an automatic and non-disruptive unwinding as the economy recovered. By doing so, it avoided the pitfall of a liquidity trap, very difficult to get out. Once having injected liquidity, how to withdraw it, what's the time? Preset dates allowed the Reserve Bank to do this. Furthermore, at the same time, while liquidity was injected, the lending standards were not diluted in terms of the counterparties or the collateral requirements, which again is a crucial lesson from the past crises. By 2022, even as the economy was recovering from the pandemic, it was hit by the global spillovers of the war and the impact of various adverse climate-related events on the domestic agricultural production and food prices. As mentioned earlier, the targeted nature of our earlier monetary stimulus allowed for an orderly, automatic unwinding. I hope I am audible to everyone. I could hear some voices. Furthermore, fiscal policy also shifted gears to the path of consolidation as the economy progressively strengthened. These factors helped Reserve Bank to be relatively better prepared to face the sharp pickup in inflationary pressures in the year 2022. Monetary policy preemptively moved to a tightening phase, beginning with the change in the stance to withdrawal of accommodation in April 2022, followed by a front-loaded rate increases, starting with an off-cycle hike in May 2022. Communication from the Reserve Bank reiterated initially the firm resolve to pull back headline inflation within the tolerance band, closer to the target, and thereafter to progressively align headline inflation to the target rate, and for a durable alignment of inflation with the target while supporting growth. This helped anchor medium-term expectations firmly to the target rate over time. A standout feature of anti-inflationary stance during this period was that of exemplary monetary fiscal coordination. As you are aware, 46% of the Indian CPI basket is food, mostly supply driven. And over there, the fiscal response, fiscal management becomes very important because monetary policy has limited impact on supply side. So fiscal response, therefore, was not just in terms of keeping aggregate demand counter-cyclical through its adherence to the fiscal consolidation path, but also of supply-side measures which sought to alleviate production or supply shortfalls and their impact on retail prices. Monetary policy, as I mentioned, would be ineffective to deal with the supply-side sources of inflation. Alongside these measures, monetary policy focused on limiting second-round effects of high food inflation on core inflation or underlying inflation trends. These monetary fiscal interactions help to balance the growth inflation considerations judiciously. A major issue that emerging market economies like India had to face during this period was the large fluctuations of capital flows, often triggered by advanced economy monetary policies. In this context, RBI actively pursued macroprudential policies to contain any domestic financial stability risks triggered by these flows. One of the key learning for the Reserve Bank from its crisis management policies was the importance of a well-laid out exit strategy from exceptional measures. This was also true for the supply-side interventions by the government, to know when to roll back the supply-side interventions, and similarly the demand-side interventions, so that as and when, they are reversed as the shocks wane out. In an age of uncertainty, the swiftness, nimbleness, and pragmatic approach of RBI's monetary policies has stood us in good stead. By 24-25, India is not only the fastest large economies growing in terms of growth, but also by February 2025, inflation was well within our target of 4%. Major financial collapses or recessions have been averted. Now, despite higher US import tariffs, trade restrictions, uncertainties going forward, global economy has stayed surprisingly resilient till now. Growth has been upbeat, defying projections, even though uncertainty has become a pervasive element of a contemporary discourse. Its tangible effects on real economy have thus far been muted. We have more to see as to how it unfolds. Global economy will, however, perform below its true potential for some time to come on the diverging growth trajectories across economies. Moreover, current trade policy environment and restrictions could damage, perhaps permanently, growth in some of the economies. Fiscally, almost every country today is quite stretched. It is not apparent how the situation could be normalized, especially if the world goes into a phase of lower economy growth. This is a risk for all of us, particularly when it is not accompanied by high inflation, though some of the large economies still have inflations above target, but it's not too high. Only some fiscal risks are being priced in by the bond markets, and equities continued rise in bond issuance have steepened several bond yield curves in the advanced economies, While central banks in advanced economies are concerned about the elevated levels of public debt in their economies and worry about a disruptive resolution, full risks perhaps are not being priced in. This raises a specter of fiscal dominance, where monetary policy could become constrained by the need to ensure debt sustainability. Equity markets too seem to be a bit complacent, and I'm talking here about the global stocks generally. They have been particularly buoyant, led by technology stocks, leading to worries that a correction might be in the offing. In all likelihood, the tariffs, combined with large and stretched public debts almost everywhere in the world, will have some material impact on the respective economies and therefore on the global economy. As of now, it seems these risks are perhaps not being priced in the equity markets. And there is a greater tolerance too for inflation. While inflation is currently range-bound across most advanced countries, it is still running, as I mentioned earlier, somewhat higher than the targets. Policymakers are showing tolerance to it, with many central banks now in a gentle easing cycle as they witness some slowdown in the growth in economy. The US Fed, for example, cut rates in September, which could be seen more as preemptive, with unemployment in US still at a low level. All these raise the question whether the central banks will be able to protect the credibility of their frameworks if inflationary pressures remain persistent. Despite geopolitical tensions that would have sent oil prices soaring in an earlier decade, they have been very range-bound. This could be due to a decline in oil intensity of GDP, not just in India, but across the world. Perhaps gold prices now are showing the kind of movement that oil used to, that is acting as a barometer of global uncertainty. Overall, despite heightened uncertainty, global financial conditions now recently have eased. Near-time global financial stability risks have reduced or are not apparent at this time, and the banking sectors, fortunately, are very resilient in most of the countries in the world. Where does India stand in this era of turbulence and heightened uncertainty? India's macroeconomic fundamentals have remained very strong, built assiduously over the decades. We have strong forex reserves, low inflation since February, a narrow current account deficit, a very credible fiscal consolidation path, and very strong balance sheets of our banks and corporates. This is to be attributed to the steadfast attention to ensuring macroeconomic stability, price stability, financial stability, and even policy stability, despite changes in government. Continuity in reforms momentum, adoption of global best frameworks tailored to our domestic needs and national priorities. It is the combined efforts of the governments, policymakers, regulators, regulated entities. All in all, despite odds, recent odds, the economy seems well settled into an equilibrium of resilient growth. This is quite a feat for a large emerging market and makes India stand out as an anchor of stability in a volatile world. Thank you. Jai Hind.
So first of all, let me say that how happy I am to have been invited by NK here. It's a pleasure. I am very happy to see a lot of friends in this room and a lot of very important thinker. So turbulent times, central banking in turbulent times, it's certainly a very, very important issue. I would say very well treated by my predecessor, Nandalal and Sanjay. I share practically very much all what they say, but I will try to introduce my own contribution to a better understanding of this particular time. A time which is from time to time changing daily to the hour when you listen exactly to what is said by an executive branch, particular executive branch, which is changing perspective very often. It reminds me the story of the two gentlemen that were in Scotland, far away from any newspaper or newsstand. So they had no information. They decided to go in a small village. There was a newsstand there. And they said, could we have the Financial Times, madam? And the lady said, do you want today Financial Times or yesterday Financial Times? They were a little bit surprised. They said, of course, today Financial Times. Ah, said the lady, if you want today Financial Times, why don't you come back tomorrow? And the fact is that it is very important to have the news of today, not the news of yesterday in the present world. So I'll try to go through turbulent times through three ways, if I may. One would be to try to re-examine what has happened over the last period of time since the Great Moderation, which was mentioned by the previous speaker, and to try to put in perspective what I would call, it seems to me that it is the best metaphor I can use, the roller coaster that the central banks had to go through during this period. Then I will try to concentrate on a number of points that are illustrating the present difficulty and the enormous, I would say, set, I count 7 of them, but there are more, dimension which are complicating the task of central banks today. And then I will conclude perhaps on suggesting an interpretation for what I consider a very important lesson drawn from the roller coaster I mentioned. So, very rapidly, we have not a lot of time. The Great Moderation, we have the memory of the Great Moderation. It's also something which is quite striking because it demonstrates that you can have a pretty good consensus of the mainstream economists, of the mainstream central banks, of the mainstream authorities, and then sharply and abruptly you realize that it was untrue. It's true that we did not foresee the terrible crisis of the subprime and then Lehman Brothers, which was a global crisis, but a very peculiar global crisis because the epicenter was in the advanced economy. Epicenter in the advanced economy, it was the first time since World War II. The previous crises were very often located in the developing world, in the emerging world, not at the very center of the financial sector of the world. And so beware of consensus. Beware of the sentiment that things are now forever in a different perspective. It was untrue after the Great Moderation. Then we had, a difficult task to address, and I spent 4 years of my life trying to address the difficulty that were stemming from the collapse of Lehman Brothers and the subprime issue, with a lot of difficulty in the euro area. We went through it with imagination and creativity. And then the main problem we had myself and my successor was the threat of the materialization of the deflationary risk. So we came from the sentiment that the territory was flat, if I may, great moderation. Then we had a permanent threat of deflation. And we tried to fight against deflation also very boldly, very actively. I have to say, all those economies that had room for maneuver were very bold in, I would say, utilizing both monetary policy and fiscal policy. But again, one lesson to be drawn. At the end of this period, it was very clear in the eyes of the mainstream, a large mainstream of economists, that inflation was totally inexistent, that we should forget about inflation, that it was very clear that we were in a different world. The world had changed, and it was a world without any inflation. And of course, again, it was a very dangerous, I would say, belief, because we had the surge of inflation coinciding with the recovery, post-COVID recovery, say. And again, we had a very high level of inflation, more than 10% in the US, around 10% in Europe, and the world over for many reasons, even if, again, the concentration on the advanced economy was very clear, it seems to me. It was more or less the same challenge than we had at the moment of the first and the second oil shock. But at the time, many central banks were loose and practiced benign neglect. It was not the case this time. And I have to mention the fact that all central banks in the world, and I praise particularly, of course, the central bankers that are in this room and in this stage, particularly India and Sri Lanka, but we had also very hard work done by, I would say, the Fed and the ECB, with 11 increase of interest rates by the Fed after the surge of inflation, 10 by the ECB. And it proved that the central bank were able to remain active, vigilant, not let things go as it was the case in the past. And at the moment I'm speaking, I would say that everything is not won, but we still are fighting for price stability, with success in India, clearly, and the flexible inflation targeting is very effective. We have inflation which went down quite well in Europe. In the US, it is a little bit more difficult for many reasons that are explainable. And of course, we also have the challenge of the executive branch. So we will see where we go. Clearly, the metaphor of the roller coaster remains a good metaphor. And the only major lesson I'm drawing from this period is that you should be vigilant permanently. Permanent vigilance is absolutely of the essence, and it seems to me this is what was said by the previous central banker speaker, that there is no case for being tranquil and thinking that things will go by themselves. Second point I wanted to make, the difficulty of the present time. Of course, I would first put the dramatic change of the global perspective that we have. We were in a rule-based international order since World War II, has been said, and we don't know where we stand now. So there is a dramatic change, a long-term, very long-term change in perspective, and we don't know where we go. This is something which is highly uncertain, a kind of Nietzschean uncertainty, if I may. So that's the first thing. I hope very much that I am a little bit dramatizing things, because what I heard here, and this morning in particular, was a little bit reassuring on the will of many, many countries to maintain order, to maintain a rule-based international system. But it's clear that it is not shared by all of us at the present moment. So I will not elaborate. Maybe it could be interesting for questions. I list the 7 points I was mentioning, which are in the perspective of the today's central banks. One, aggravation of geostrategic tensions in many places in the world. Second, weaponization of economic and financial relationship, associated, of course, with my remark on the change, the dramatic change of concept. Third, slowing down of globalization, which is started before the drama I am mentioning and the dramatic change of concept, which is in the air. But slowing down of globalization is very important for central banks, because it means additional pressure for inflation. I mentioned the green transition, also very, very important, not only for the planet, for the spaceship in which we are, but also because it is something which has consequences on inflation, in my opinion. It's not without cost. I would mention also a political element which is very, very important for central banks, which is the political insatisfaction of the lower middle class, which was very, very clear in the United States of America and contributed to change dramatically the executive branch and the nature of the executive branch. But it is observed in all countries, emerging and developed, advanced and developing. So there we have a major problem, which is a major problem also for central banks, it seems to me. The fact that the Republican administration took over the Democratic administration with the support of a large part of the lower middle class means something very, very important. Then we have, of course, all the technological shocks that India knows better than anybody, because India is at the heart of the engineering of these technological shocks, the deep learning, AI, generalized digitalization. And of course, this has consequences on productivity, on the march of the economy. It's something which is absolutely of the essence. We have also particularly for central banks, the cryptocurrency challenge, the stable coins challenge, all these new technologies that are of extreme importance and might change dramatically, to be frank, particularly because of the push that is clear coming both from the private sector, for reasons that are obvious, and also from the public sector, from some executive branches that are pushing and pushing and pushing. And it seems to me that it has to be examined very carefully, not rejecting, of course, technological progress and progresses, but trying to be, again, as vigilant and as wise and rational as possible. That being said, I go to my conclusion. I wanted to draw your attention to the following. In the moment of the financial crisis, say, caricature, 08, 09, 10, 11, 12, we had the surprise of being in highly turbulent waters when unexpected. One of the lessons which was drawn during that period was that the anchoring of expectations was of extreme importance. And of course, particularly anchoring of inflation expectations. We had already, of course, inflation targeting concept. We had the European having said that they had a definition of price stability, the famous 2% over the medium term. And what I would like to draw your attention to is that not only this definition of price stability, as I like very much to present the new concept, but also the idea that it should be generalized not only to the developing world, and emerging world, but also to the advanced economy. The fact that the US decided to adopt in 2012 2% as its definition of price stability in the medium run. The fact that Japan decided to consider 2% as its definition of price stability over the medium run completed the fact that 4 major advanced economies that are in the basket of the SDR, the special drawing rights, together with the renminbi, but those 4 had the same definition of price stability after the decision taken in Washington in 2012 and in Tokyo in 2013. The 4 currencies that are issued by advanced economies that are in the basket of the SDR have the same definition of price stability. And in my opinion, it is something which is currently under-assessed by academia, because academia consider each country, each entity for itself. But the fact that at the global level, what is still the core of the international monetary system, waiting, of course, for numerous emerging economies, currencies to join in. But at the present moment, the SDR is, I would say, an emblematic core. Then we have the same definition of price stability. And my understanding is that it played a very important role in permitting us, I mean the US, Europe, and of course the other currencies that are in this basket, to progressively eliminate the inflation that had come up. And I put part of the credit of the success of central banks, not only the central banks I have mentioned, but also all central banks of the world, namely avoiding to embark in a new round, a new episode of high inflation. I put part of the credit on this, I would say, de facto, not de jure, but de facto structural change in the core of the international monetary system. I say that to terminate on a positive mark, because most of my remarks were rather negative. Thank you very much for your attention.
Thank you very much, both Governor Malhotra and Governor Trichet. So let me, I think we have some time just to basically raise some few comments and the questions, especially start with Governor RBI, Governor Malhotra. We heard in the morning the Minister of Finance talking about the medium to long-term sustainable growth of 8%. Is obviously, we all know, is a challenging and ambitious target that needs a lot of structural reforms implemented for us to move, for India to move in that kind of a very high medium to long-term growth path. So in this kind of target in mind by the government, then obviously other part is the central bank independence and accountability. We know now central banks are increasingly, even in our region, becoming more independent and also with a lot more accountability and transparency. So with this democratic accountability and independence, and also looking at the ambitious targets of the very high growth rates, especially in India, and obviously there may have some conflict between the central bank, may have short-term priorities in terms of stabilization versus medium to long-term growth. So I think, how do you see this kind of conflict, and how do you see going forward for the RBI? How do you see the address, or what are the things that in central bank mind to address if this is dash, if I call it as conflict, or if it's not the conflict, but how you align with, especially with the transparent and accountable central bank with independence.
Yeah, this is an interesting question. India did grow, about 8% last 3-4 years. So in that sense, it gives the confidence to the finance minister and to all of us that we can certainly, grow 7 to 8% long term. As you are all aware, the Reserve Bank has the primary mandate of price stability, but it is conditional, or at the same breath, it talks about keeping in mind growth. So while the primary focus certainly for us is growth, is price stability story, growth also is kept in mind by the Reserve Bank. Independence, this is a question which now has engaged the attention of the world, especially what is happening in some of the countries, advanced countries. And in India, we have a very unique, I think the reference here, again, when we are talking about growth, inflation dynamics, it's more relevant to the monetary policy. And so over here, we have a very unique kind of a framework, where the framework, of course, has been now embedded in our legislation after the amendment which were carried out in the RBI Act, which talks about this inflation targeting as the primary target for the central bank, for the Reserve Bank. But then it's the government which sets the target. It's not the Reserve Bank which sets the target for itself. So over there, RBI, the central bank, has a role. It is consulted. Every 5 years, we do a review, as you're all aware, and we are in the midst of a review. So while it comes to setting of the target, there is no independence that the Reserve Bank has. It only has a view which is communicated to the government, and the final buck is with the government. Coming to the operating tool for it, which is the policy repo rate, again over there, as embedded now in our act, there is a monetary policy committee. So it's not the RBI, it is the monetary policy committee with internal members from RBI. RBI has a major say over there, but then external members to have an equal say. So over there, the Reserve Bank has more of an, if you call it, independence or responsibilities. The responsibility shifts from the central government, which had target fixing primary role, to the operational target policy rate being set by primary role, shifting to the central bank. The third lever, or the third piece in this framework, is how to attain the operations which are to be done to align the operating target to the policy repo rate. And it's over there that there is complete flexibility or independence which is given to the central bank. And it is the central bank that decides how to go about doing it. And even over here, the independence is, while there is independence, at the same time, there is accountability embedded into it through a report which is to be sent to the government in case successively the target is breached. So while independence, of course, is necessary for monetary policy, one can see, how in India we have tried to balance these goals of independence on the one hand, and accountability, again, which goes hand in hand for any independence that you may give. So I think it has worked very well. Talking about independence, it's important not only for institutions, it's important for individuals within an institution, within government, within RBI, and this is certainly a virtue, a feature which we all need to promote and protect, and India has done very well in giving the Reserve Bank, its central bank, the independence where it is required, but with accountability features are built into it.
Thank you, Governor. My next question to Governor Trichet, as long-serving at the ECB and the French Central Bank, and we know when the currency union, the euro was introduced some time ago, so the expectations was that this currency certainly expectations was that will emerge as an alternative reserve currency and also alternative trading currency, at least the basically moving as alternative to the US dollar from that point. But historically, if you look at now, it has expectations. If that was expectation, it has not basically not reached to that level. But when you look at the current global turbulences, and usually in the past, when there's a global uncertainty, what we have seen the safe haven has been mainly to US dollar and the gold historically. But this time, what we are seeing, the gold obviously has gone way high, above all central banks are moving into gold as a safe haven and also as a asset class. Whereas the current cycle, we have not seen the US dollar as becoming that kind of safe haven. And is this an opportunity, in your view, for euro to become at least gradually move into that kind of as a safe haven for global investors, given the uncertainty, especially in the US dollar, with all BRICS are now trying to emerge as coming up with all the other currencies. Internationalization of local currency also, or another kind of effort taking place, and also the gold obviously become a winner there. And also other part is that instead of the US dollar, now we are seeing the virtual currencies also now gaining traction. Sometimes some of the private investors are now relying or keeping basically more weight on the virtual currencies, although small. So what is your view? Isn't this an, you think, is opportunity for euro to gain that traction, to become more of a safe haven or the trading currency in the global trading system or investment systems? What's your view? So based on your experience. Thank you.
Thank you.
Thank you very, very much indeed. A lot of questions implicitly or explicitly in your remarks. First of all, let me only say that as far as we are concerned, the central bank, the ECB, has not only operational independence, but I would say full independence. That being said, of course, in all our meeting of the Governing Council, you have the presence of the representative of the Eurogroup, namely the chief, if I may, of the Ministers of Finance. He's present, can be present, he's always invited. You have also the commissioner, the competent commissioner. We are reporting, the ECB is reporting to the European Parliament at least 5 times a year. And there is a lot of contact and I would say response to questions of all kind by Parliament, by the Commission and so forth. But the decision is really taken entirely by the Governing Council itself. And I think that it has worked pretty well, because the argument against this kind of full independence is generally that the central bank will not take into account the environment, the difficulty of the new things that are coming would stick to, I would say, previous ways of looking at things and not be sufficiently aware of the difficulty. I think the ECB demonstrated in the major crisis that we have known his capacity, her capacity to deal with extraordinary new challenges. And I think that we have now a very good support by the people of Europe. By the way, I insist on that because when we started the euro, there was a generalized skepticism in many countries, the world over, of course, but also in Europe. It was a very close call. In France, it's very well known. We had a referendum and it was a terribly close call. In Germany, the same, because it was a very close call in the Bundesrat, the province, the Länder, I would say, assembly. So now when we ask the people of Europe, they say that they approve of the euro by between 80%, 70% and 80%. So from that standpoint, it's a real success.
Yeah,
Now,
thank you, Governor. I think we have only 2 minutes. I would like to give 2 minutes for the at least one question because of the just opportunity for audience to ask at least only one question, please. In 2 minutes. So please, first thing. Okay.
Thank you, Jean-Claude. If you had your way, and I'm not saying you will have your way, but if you had your way, how would you like the relationship between European Parliament and the European Central Bank to be recalibrated in any way by modifying the basic objective of combining multiple things, of which, of course, inflation, but growth equally would be an important variable? Do you think that, given uncertainties, the G factor has an increasingly more dominant role to play?
I would say...
You have 1 minute, please.
Yeah, I understand. I would say I will not change anything, first. Second, the central bank, according to the treaty, is supposed, not forgetting her first mandate of price stability, to support all the objectives of Europe, including, of course, growth, including the green transition and so forth. My understanding is that the necessary but not sufficient condition to have maximized growth is to have price stability, credible price stability in the medium term. Of course, it does not suffice. It's a necessary but not a sufficient condition. But I will be against the two objectives, which I trust creates a problem in democratic terms, because you would give an independent institution the independent authority to make a choice, to make an arbitrage, say, between price stability and growth. It seems to me too much for, again, an independent institution.
Thank you. Thank you very much, Governor. So with that, I think we conclude the session. Thank you very much.
Thank you very much.